Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, bolting it all together in retirement.
Thanks, Dallas. A brief recap. Part one of bolting it all together was as you approach retirement, so while you were still working. We spoke about the last 10 years of someone's working life. A couple earning $90,000 each could claim up to $113,505 of personal tax returns by contributing the right amount to superannuation. We subtract 15% earnings tax from that. A net benefit of $64,155. Yep. Also, the other things that they could tap into with a spouse contribution and then a government co-contribution. So what we're looking at right now is they've gotten to that stage where they're retiring, and we'll look at retirement, in retirement, and at the end of it all. At the end is a polite way of saying when they die, isn't it? Well, I didn't want to say when they die. And we're all going to die at some stage.
I must say before we get into that, you really sold me on the part one of this series with a quick recap. It sort of makes me want to go back and listen to it and pick up some of those tax savings. So if you are still working, and then that's obviously going to be the most important part. But I think the reason why we've done this as a bit of a two-part series, or the reason why we've talked about this in this whole chronological order, is the concept of what we're talking about here is bolting it all together, getting everything to tie in to achieve the outcome you want. So picking up all the tax savings and doing all the great work while you're still working and leading up to your retirement is useless if it doesn't flow through to give you the best possible outcome, as you said, at your retirement, and then all throughout your retirement, and then, when you pass away. So what we're talking about now is that we've spoken about how to build up those retirement savings and how to do that in the most effective way. Now we're talking about some of the other options available to you, or some of the things that you can take advantage of, and some of the strategies that we can sort of tie in together to pick up all the savings that we possibly can at retirement and all throughout. So first one was at retirement.
So at retirement, we commonly, I'll just give you an example here because it's a real life example. Some clients of mine have just recently retired, and they actually both retired before either of them hit pension age. The male in that couple has just reached pension age. Yep. So basically, what happens is that they would generally not qualify for any age pension whatsoever. Because of their assets test. So when you apply for the age pension, the Centrelink looks at the assets test and the income test. Now, you and I both know that Centrelink only assess certain assets for people that are of pension age. And if you're under pension age, which the female is, and she won't qualify for a bit over 2 years, Centrelink won't assess certain assets. And one of those assets is a superannuation accumulation fund.
In her name.
So the female in this situation, because they've retired previously, they were retired before they were in pension age, we started superannuation income streams with both of them. Mm-hmm. So we're about to apply for the age pension for the male, and it's worth $17,000 per annum to him. He'll only get it for 2 years because when I go through this example, but that's $34,000 that they wouldn't have ordinarily got.
So that's a really good example of one where, obviously, and you just touched on the superannuation income stream and a lot of those things that we'll talk more about in retirement. There's a lot of other things, but there are some certain advantages that you can pick up at that point of retirement, or in that year of retirement, or the couple of years immediately afterwards, and that's a great example of one. So, as an example, if you've got when we're talking about those asset tests for Centrelink, if you've got a couple in that example where the husband is slightly older than the wife, they might have $1 million in superannuation accounts, but if that $1 million is in his superannuation account, it's treated as an asset for Centrelink purposes, so they wouldn't be eligible for any age pension. However, if that $1 million is in her superannuation account and she hasn't reached age pension age, it's not assessed as an asset. So they would be able to go to Centrelink and say, we don't have any assessable assets. So that's where you would be able to get the full $17,000 age pension for him for that couple of years.
Yes, so that's exactly what we're doing. We're basically moving her superannuation income stream, which would be assessed as an asset if she left it as it was. We're moving that back to superannuation accumulation phase. It's not a huge change from a paperwork aspect, but it makes a big difference to them. It's about $17,000 of age pension that he will receive. She will pay a little bit more tax
on the earnings.
What we're doing is we're moving something that's being taxed. Her super fund, her super pension fund. So we talked this for people that have listened to more than one podcast, you would know we refer to this as an account-based pension or a superannuation income stream. It's basically getting to retirement and ticking that box to turn your superannuation fund, which is taxed at 15% on the earnings, ticking that box to have that taxed at only 0%.
Yep.
We're moving that from a 0% taxed fund back to a 15% tax fund. Now, the difference that she will pay, we've worked out as a maximum inside of superannuation on the earnings tax. It's a maximum of about $3,500 per year.
You've done that calculation and gone, by making this change, we'll pay maximum $3,500 more in tax on the earnings on that money. However, we will get a guaranteed age pension income of $17,000
of $17,000. Yeah, so it's really a no-brainer from that point.
Yeah,
like I said, it's available for 2 years. So in 2 years' time, she will attain age pension age.
Yep.
We would let's back up a bit. What we're doing here is we're legally hiding money in the superannuation fund. So it's one of the legally hiding money. This is perfectly legal.
Yes.
When she reaches age pension age, there is nowhere to legally hide money anymore. So
you then get into other types of hiding money, which we're not talking about here.
So Centrelink will look through that,
yeah,
and they'll say she's in a superannuation accumulation fund. She's now age pension age. We're going to treat that as an asset. Yeah. What they're doing now, what Centrelink is doing now, is they're saying, despite the fact and ignoring that she was retired already and she'd voluntarily made the decision to retire, if she puts money back into a superannuation accumulation fund, she's within her rights to continue accumulating for retirement because she's not of age pension age yet.
Yep.
And therefore, and it's correct, they won't treat that as an asset.
Yeah,
they're
basically saying that's something that you're accumulating for your retirement. You are not drawing income from that yet.
Yes,
yeah,
and it's been a double-edged sword, I guess. The gradual pushing back of the age pension age from 65 to 67, and it's on a sliding scale. Yeah. So right now, you need to be 66 right now we're recording this in January 2020, so my client is turning 66 in January 2020. He qualifies
21.
Sorry, 21.
Yeah,
sorry for confusing everyone. January 2021 we're recording this, so he turned 66 this January 2021. He qualifies for age pension. His wife is younger than that.
She's not eligible.
She's not eligible till 66 and a half. So it's on a sliding scale. So, but she won't be 66 and a half for another 2 years.
Yeah.
So basically at that point in time, Centrelink will look through their entire assets and say, these guys as a member of a couple are in excess of what they, of the assets test.
Yes.
Lower limit.
Yeah.
They therefore don't qualify for any age pension at all.
Yep.
Right now, though, like I said, we can legally hide money in her superannuation fund. Centrelink will not assess that as an asset. That qualifies him for $17,000 of age pension for 2 years.
Yeah.
$34,000 of total benefit.
Yeah.
we subtract out of that $7,000 in extra tax she's going to pay by moving from a 0% taxed super fund to a 15% taxed super fund, which is required to achieve this benefit. $3,500 per year times 2, $7,000. So $34,000 total benefit. We subtract out $7,000.
Yeah,
she's at $27,000. They're at $27,000 net benefit.
And that's another good example of one where that's just through putting all that together, putting together the we've already built up the money in your retirement savings. It's bolting it together.
I've got my hands coming together. You can't see that on when you're listening, but we're bolting it all together.
So it is, and that's a part of what you have to. All these things have to tie in together. It's which one is best, because if you weren't aware of the effects of that Centrelink, you would say, well, I want all that money in the super income stream. I want a 0% earnings tax on that. That's the best. But then you have to be able to do that trade-off and go, well, bolting that together with what we know about the Centrelink rules, which one is actually better there? The other point that I want to make before we move on from that one is because I've got a client who's going to be in a similar position, but they're actually 2 years out from that. So when we talk about bolting it all together and the different timeframes here, this is all they all flow in together. So these clients of mine that are 2 years out, we're already working on getting as much money as possible into her superannuation account so that we can take advantage of this in 2 years. What you don't want to do is get to that point and then go, okay, geez, it would have been good if we could get some Centrelink, but we can't because the balances don't line up and that sort of thing. You really want to be running a few years in advance and thinking of where are we trying to get to? Is this a strategy that's available to us? If so, what do we need to do now to maximise their ability to take advantage of it? And so, as we go through each of these timelines, it's really something that it's not as though we look at the tax deduction side of it while you're working and then get to retirement and go, okay, now how do we maximise Centrelink? We really got to look at it the whole way through while we are still working and thinking the next thing is going to be that retirement and potentially some age pension. How do we make sure that what we're doing now ties into that? And then, as we say, the next part of that is flowing throughout your entire retirement. So that's your next timeline of events. Yeah.
So the classic tax deduction whilst you are in retirement is to have your money in that 0% tax superannuation income stream, account-based pension fund.
Yep.
And what that is really is that just think of it as a tax-free company. Yep. So you've built up your money. It's built up in superannuation. It stays in superannuation. Mm-hmm. We like to refer to it as a tax-free company because it helps people conceptualise it a little bit better, I think.
Yeah. It's just an entity that you own those assets in.
If you had a company that made you an income each year, let's call that income $90,000 a year. If that was a tax-free company, you wouldn't pay any tax on that on what the company made you, and you could take a tax-free income out of that for $90,000 a year. What that is a superannuation income stream or account-based pension in retirement. So you have to be age 60 at least and retired to be able to achieve that. The example that I would use here is if you build up enough money in your superannuation fund and then you switch into superannuation income stream, 0% taxed environment, a la that tax-free company in retirement, if you're able to draw $90,000 a year out as an after-tax income and you don't pay any tax on that income, which I just mentioned, and you were able to do that for 30 years, which is the standard retirement lifetime for a member of a couple, what it would do is it would save you in the vicinity of about $900,000 in tax. Now, where I came up with that figure, Dallas, is that while I'm working, if I'm on a $120,000 salary, I actually lose $30,000 in tax, in income tax, to leave me with only $90,000. So people always say I'm on $120,000. What they're really on is $90,000 because that's what they take home. When you're in retirement, if your money can make enough money to pay you a $90,000 income from your superannuation income stream, what you're really doing is saving $30,000 in tax per year comparatively, compared to if you were earning
a
wage income
and
earning $120,000, you'd be paying $30,000 in tax.
Yep.
You're paying $0 in tax. You're saving $30,000 in tax times 30 years. That's a saving of $900,000. Now, in order to draw $90,000 a year from your superannuation account income stream, what you actually need is you need to get enough money in there to be able to support that. It has to be invested in the right environment to generate enough rate of return. I'm not going to say your money gets stressed and goes to work for you, Dallas. Listeners love it, but you hate it.
But, every time you say, I'm not going to say the thing that you say every time.
So I mean that's where bolting it all together comes into play as well.
A point to elaborate on there, Michael, is you were just saying about if you went to work and earned that 120, even as a comparison of if you were in retirement and you didn't have that money in a super income stream or in an account-based pension, if you just had your retirement savings invested in your own name, in one person's name, it's the same comparison where if a person who had, you would have to own enough assets to have $120,000 of taxable income flow through to you from your investments as just that investment return, you would still pay the $30,000 tax on that because that would be income to you personally. So the comparison you've used there is if you're going to work, because that's sort of what's easy for people to conceptualize at the moment is they go to work, they earn 120, they pay $30,000 in tax. Now, if you're retired and you have all your assets owned just in your own name, your money gets stressed and goes to work for you, as you say. That money earns $120,000. You still have to pay $30,000 in tax. Now, if you've got that money in a super income stream in that tax-free company, you only need enough money to pay you the $90,000 in income because you don't pay any tax. So the comparison is that you basically, you need 3/4 of the same amount of money because you just don't have that tax bill every year.
Yeah, really good point to make there, absolutely. So, and you can think of that in a number of different terms. You could think, okay, if I've got enough to make me $120,000, if I own it in the right structure, I pay $0 in tax. If I own it in the wrong structure, I pay $30,000 in tax.
Yeah.
If I own it in the right structure, I can take $90,000 from 120. I'm reinvesting $30,000 back into my fund versus that money getting kicked out to our friends at the ATO. That puts me in a great position to do that into perpetuity. I mean, I can continue to draw that $90,000. I can even index that up, of course. Because I don't have $30,000 getting wasted.
Or more exciting, what you can do is take the $30,000 every year and spend it on an awesome overseas holiday, which most people who listen to this probably go, that's pretty cool too. Yeah,
look, there's so many different things you can do, and it's all about bolting it all together so that you don't volunteer that tax. And you mentioned before, Dallas, that starts with planning way out. Most commonly, we see the problem where people are building up money in their own names and therefore are susceptible to paying that extra tax is through rental properties because traditionally, they're bought probably for the wrong reasons at the start a lot of the times, which is to claim a personal tax deduction and to make money out of them. What tends to happen is that people get a lot of them, so they end up with 3 or 4 or 5, and then they get to retirement, and they end up with 4 or 5 rental properties in one person's name. Usually the highest income earner. All of a sudden that person wants to retire, and then it's a problem to actually get them out of that person's name and get them into superannuation.
That's exactly right, and that's sort of what we're talking about there. Is that you've got to be planning for that in advance. Is that strategy of building up assets in your own name is. Even if it goes right, even if everything goes right there and you end up with all these assets in your own name, you need another, you basically need four lots instead of 3 lots to give you the same income because you just don't have it in that same tax effective environment. So anyone who's listened to this podcast for any length of time has probably heard us bang on about the super income stream environment or an account-based pension. So if you go back to episode, if you haven't heard us bang on about it before, we would be surprised because we love it. We think it is the holy grail of where you want to end up with your retirement savings. It's just a fantastic ownership structure. If you haven't heard us explaining that in great detail, go back to episode 57, what is an account-based pension, where we go through all that in a bit more detail. But suffice it to say that, as you can see there in that example of, it's such a huge advantage having that money in that right ownership structure in retirement, in that tax-free company. The return that you get is the after-tax return you get is just so much greater.
And at the end,
I
was going to say finally at the end. That's even more morbid. But so at the end,
yeah. So we're talking about here when you pass away. So
yeah. So we've spoken about at retirement, at that snapshot point in retirement. Just a quick recap.
Yeah. So
most commonly, someone can take advantage of. In my example, clients with one member of the couple qualifying for age pension now, the other one not qualifying for another 2 years by age.
Yep.
$34,000 of benefit during retirement, during that 30 years of retirement.
Yeah.
If you can draw $90,000 a year from your superannuation income stream and you're paying 0% tax on that, $30,000 of tax saving compared to earning that in one person's name, $120,000 and paying $30,000 in tax, $900,000 different. At the end now, we're talking about right at the end of someone's life in this situation. So, and we're talking about, I guess, estate taxes.
Yeah.
You know, we're all about having, of course, the least amount possible go through to the ATO.
Well, I think that's a good point, because if you talk to people about what do they want when they pass away, some people like my parents would say they want to spend every single dollar they've got on the day they spend their last dollar on the day they die, which is fantastic. You have other people who want to leave money to their kids, which is also great. No one ever says, when I die, I really just want a big whack of my money to go to the ATO.
Yeah.
There's no one who says that. It's either you either want that money to be available for you to be spent, or in most cases, if you can't spend it, you want it to go to your kids. No one wants it to go to the ATO.
No. Tell us what you know.
Well, I could tell you what I know, or I could just refer you to a podcast that I previously did. And I actually remember this because I did a fair few. We did some calculations, some workings, and some examples there of when you pass away, your money that's in superannuation or in a super income stream in that environment, if your spouse, if it goes to what they call a tax dependent, so your spouse, generally in this case, husband passed away, if his wife is still available, she gets that money tax free. Now, I won't even go into the detail of what happens if she has too much money in an income stream, she can't necessarily keep all of his money in the income stream and vice versa and all that kind of thing. But what we're really talking about here, there's a whole different strategy there about how to keep as much as possible in those tax advantage environments. What we're talking about here is when the surviving spouse passes away. So if there's a husband and wife, on average, unfortunately for us blokes, Michael, the husband will pass away first. The wife will be left with the money in the super income stream, hopefully. When she passes away, if that money goes to their adult children, what happens is those kids are deemed to be what they call a non-dependent for tax purposes. The money that's in their super income stream that has been built up from before tax contributions has an extra lot of tax to pay on it. So, and it works out to be about 17% on that portion of it. So what we're talking about here, there are a few different strategies, but what we're trying to minimise is that 17% inheritance tax on that money going to your adult children.
Yeah, so basically what you're referring to there, Dallas, and not many people know this because it's not reported on your statements.
No.
There's a tax-free component of someone's superannuation balance or super income stream balance.
Yeah.
And then there's a taxable tax component.
I was about to say.
Real quick example here.
Yeah.
And those sub balances could be zero, or they could be they could be anywhere from 0 to 100% of your account balance. So I mean, if you had a $1 million fund, and $500,000 of that was in the tax-free sub-balance,
Yep.
and $500,000 of that was in the taxable tax sub-balance.
Yep.
On the death of
The surviving spouse.
the surviving spouse,
Yep.
let's call her Mrs. Smith here.
Yep.
She's paying that money to her adult children who are probably 60 by that stage.
Yes.
You know what I mean?
Yeah,
Like
yeah.
with longevity and things
Yes.
like that. That would be the average age. So they're not kids.
Yeah.
And therefore they're not tax dependent beneficiaries.
Yep.
What would happen?
So the kids would get the $500,000 tax-free portion.
Yep.
They get that tax-free.
Completely tax free.
The taxable tax portion, the other $500,000, they pay 17% tax on that. So they pay $85,000 in tax on that. So of the $1 million balance, Mrs. Smith only really gets $915,000 that goes through to her kids.
Yep.
Now, and we won't go into the detail of how to do this, but if she was able to, throughout her retirement or in the early years of retirement or potentially even leading up to retirement, if she had the number one financial planner in Australia, aka Dallas Davison, on the job, we would have been looking at that already and going, how do we know that, you know, in a perfect world she's going to die peacefully in her sleep at 90 years of age, and this money is going to be money left over to go to her adult kids. What we really want to do is we want to minimise the taxable taxed component of that super and of that super income stream, and we need to do that very early on in the piece. So there are different strategies and I went through these in fair bit of detail in that previous podcast, which was episode 39. So if you want more detail about some of the different ways that you can do this, go back and listen to that episode 39, how to minimise your 17% inheritance tax. But basically, you really need to be doing that up to retirement, and in the early years of retirement, what you're trying to do is get as much as possible into the tax-free portion of your retirement savings, and then throughout your retirement, the next part of that is that you really want to spend the taxable portion first, because as we just touched on, if you're in a super income stream, any income that you pull out of that, it doesn't matter where it comes out of, it's going to be tax-free to you as an income that you pull out of there. So again, in Mrs. Smith's case, if she had $500,000 in the taxable portion and $500,000 in the tax-free portion, what we'd actually be saying is you have to take your minimum payments out of both of those, but any extra amounts you want to take out of the taxable portion first. So as I say, if her attitude was, I want to blow it all as much as possible before my kids get their hands on it, what I'd be suggesting is blow the $500,000 of taxable money first, so that whatever's left over is to go tax free to those kids.
Just pause.
So just to clarify with that, you can't choose, if you've only got one account, you can't choose which portion you take out of there. What you'd actually have to do is have two separate superannuation or two separate super income stream accounts. And that's sort of what I was touching on before, is that you need to be preparing for that 30 years ago. And so I've got clients now who are still accumulating money, still leading up to retirement, and they've actually got two separate super accounts, one which is tax-free and one which is taxable, so that we can then, throughout their retirement, as we're building up that money, we can build it up in the right account, and then throughout retirement, we can just draw from one of those instead of the other.
And just to give a quick example of how you might build up, because people, I think, listening might think, gee, if I've got the choice to make money go in tax-free or taxable or into the taxable taxed proportion, I'll be choosing tax-free. So what it is and what you're referring to there, Dallas, any money that your employer puts in for you, or any money that you put in and claim as a tax deduction, goes into the taxable taxed proportion. Now, you're better off doing that.
Yes.
Still up to the limits that you're able to claim that as a tax deduction. With any money that you have that goes in, and this goes in standard, most commonly as lump sums from the sale of other assets, such as you sold a house and you want to put $300,000 by bringing, you're allowed to put $100,000 into the tax-free proportion effectively per year. If you're not claiming a tax deduction on that, you can bring forward 3 years of that. So, in a simple example, I guess, if a husband and wife sold a $600,000 rental property, and they could effectively put in $300,000 as a tax-free after-tax amount, into each of their funds in one particular year by bringing 2 years forward. I'm digressing a lot here, but and what you're saying there is that if you separate that out into a separate fund, to have that money nice and clean, all in the tax-free proportion, way down the track when they're in retirement, or just down the track when they're in retirement, any additional money that they need to take out as income, they're taking from the the taxable tax proportion, which is confusing because it's tax free when you're still alive. So
that's why
again, like without getting, this is so complicated, and this is the topic of this podcast is bolting it all together. You and I are specialists in bolting all this together so that people don't have to sift through all the legislation,
all the trade-offs, do the comparisons of which road should I go down? Am I better off saving tax now or in 10 years' time, and what's the difference there? Like you say, that's our job, and that's I think that's like I said, there's probably another 5 or 6 podcasts that I'd like to do about this estate planning and that tax planning for your estate, because there is a lot to it, but it's one of those things, like I say, where it sort of ties in neatly that you go, for most people, when they come in to see us at 55, what you really, people want to save tax in that year. And that's obviously, they're earning good money. They want to pay as little tax as possible so they can save as much as possible for retirement or spend it, as the case may be. But you really got to look at it as, okay, I don't just want to save tax in this year. I don't just want to take advantage of what I can in this year. I need to be taking advantage of what I can in this year and having that flow through to put me in the best position at retirement. So in that example, how do I maximise Centrelink at retirement? There are a couple of different things that you can do at that point of retirement. How do I minimise the tax that I pay the whole way throughout my retirement on the earnings on my retirement savings and on the income that I draw out? And then also, how do I minimise the tax that I'm paying when I pass away and that money goes to my kids?
Probably a great place to wrap up. It's been very involved, part 2. So thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.